Look at this chart. Bitcoin isn't just dipping. It's falling at the exact same time global liquidity is tightening. And that's not random. Because every major Bitcoin boom has lined up with money flooding the system, and every major crash has lined up with that money disappearing. So before we blame crypto drama, before we blame headlines, before we blame whales or ETFs, there's one question we need to answer. Is this really about Bitcoin? Or is it about something much bigger happening underneath the financial system? What is actually going on? Because Bitcoin wasn't supposed to behave like this. It was designed to be independent, decentralized, disconnected from governments and central banks. And yet, every time global markets get nervous, Bitcoin moves with them. So if this is just crypto volatility, why does the timing feel so familiar? Here's the uncomfortable answer. Bitcoin doesn't trade on ideology. It trades on liquidity. And liquidity might be the only thing that actually matters. Let's zoom out. Over the past decade, Bitcoin has gone through dramatic booms and busts. That part isn't new. But what is interesting is when those moves tend to happen. 2020, stimulus everywhere, rates near zero, money flooding the system. Bitcoin explodes. 2022, rate hikes, quantitative tightening, liquidity pulled back. Bitcoin collapses. That's not a coincidence. In 2020 alone, the Federal Reserve expanded its balance sheet by trillions of dollars. Global liquidity surged. Risk assets everywhere went vertical. In 2022, that liquidity reversed. Rates climbed at the fastest pace in decades. And speculative assets were the first to crack. If you overlay Bitcoin's biggest rallies and sharpest crashes with global liquidity conditions, meaning how much money is flowing through the financial system, you start to see a pattern. When liquidity expands, Bitcoin surges. When liquidity tightens, Bitcoin struggles. And right now, liquidity is tightening again. Interest rates are higher than they've been in years. Central banks have been shrinking their balance sheets. Borrowing is more expensive. Risk appetite is cooling. That matters more than most crypto headlines. Because Bitcoin, despite its original vision, trades like a high-risk asset. It behaves more like a leveraged tech stock than digital gold. When money is cheap and abundant, investors are willing to take risks. They buy growth stocks. They buy startups. They buy speculative assets. And yes, they buy Bitcoin. But when money becomes more expensive, when yields on safer assets rise, when uncertainty increases, investors rotate toward safety, and risk assets feel the pressure. This isn't about one regulatory headline. It's not about one ETF inflow or outflow. It's not about one tweet. It's about the financial backdrop. Bitcoin doesn't live outside the system. It responds to it. Now, here's where it gets interesting. A lot of people still think of Bitcoin as a hedge against inflation, a hedge against currency debasement, a hedge against instability. But historically, during moments of real stress, like the aggressive rate hikes of 2022, Bitcoin didn't act like a hedge. It acted like a risk asset. It moved with tech stocks. It reacted to interest rate expectations. It followed liquidity. And that's not necessarily a bad thing. It just means Bitcoin's role in the market might be different than many expected. Because assets don't trade based on belief. They trade based on flows. If capital is flowing into the system, risk assets rise. If capital is being drained, risk assets struggle. And right now, global capital conditions are not as loose as they were during the massive stimulus era. But here's the part most people miss. Liquidity doesn't just change price. It changes behavior. When liquidity is abundant, investors think long-term. They tolerate volatility. They embrace narratives. When liquidity tightens, psychology shifts. Time horizons shrink. Conviction weakens. Everyone becomes more sensitive to downside. Bitcoin amplifies that shift because it sits at the far end of the risk spectrum. It doesn't just react to liquidity. It exaggerates it. Because it's volatile. Because it's leveraged through derivatives. Because institutions now participate in size. Which brings us to the bigger question. If Bitcoin continues to behave like a high beta asset tied to global liquidity cycles, is it becoming integrated into the very system it was meant to disrupt? The more ETFs exist, the more institutions allocate, the more leverage builds into the ecosystem. The more Bitcoin becomes sensitive to the same macro forces driving everything else. That doesn't mean it can't recover. It doesn't mean it's finished. And it doesn't mean long-term narratives disappear. But it does mean short-term moves often have less to do with crypto drama and more to do with global money conditions. And here's the paradox. Bitcoin was created as an alternative to the system. Yet today, its price is heavily influenced by the system's liquidity. That's not failure. That's integration. So instead of asking, why is Bitcoin crashing? Maybe the better question is, what is happening to liquidity? Because Bitcoin isn't moving in isolation. It's moving with the tide. And tides don't turn because of headlines. They turn because the underlying flow changes. If liquidity expands again, Bitcoin may rise again. If liquidity tightens further, volatility may continue. But the key variable isn't a tweet. It isn't a rumor. It isn't a single ETF flow. It's the cost and availability of money itself. And that's something worth watching.